Have you ever had that feeling of déjà vu? Well, if you're looking at the stock market these days, it is really hard not to feel like we've been here before. You know, the excitement, the massive investments, that feeling that this time is different. Okay, let's dive into this and figure out if the current AI boom is a genius investment opportunity or if it's just history repeating itself.
You gotta love this quote from the legendary investor John Templeton. It's the perfect place for us to start. I mean, it's such a powerful reminder that hype and overconfidence have been around in financial markets forever. So let's keep these words in mind as we try to figure out if this time really is different.
To really get what's happening today, we need to take a quick trip back to the late 90s, the dot-com era. Man, that was a frenzy. Seriously, everyone was just throwing money at any company that had a .com in its name. The market went straight up until, well, it didn't. When that bubble burst in 2000, the collapse was just spectacular. The Nasdaq crashed by almost 80%, and less than half of those internet companies even survived. Okay, now fast forward to today. That same electric energy is in the air. You can feel it. You hear people talking about a once-in-a-lifetime opportunity. But this time, the buzz isn't about the internet. Nope, it is all about artificial intelligence.
So, this brings us to today's AI arms race. And what might surprise you is that the direction of the entire stock market, and yeah, probably your own portfolio, is being heavily shaped by just a handful of massive companies.
These are the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. Together, they make up a staggering 36% of the S&P 500. Just think about that. It means that even if you just own a simple index fund, you are already making a huge bet on these specific companies winning the AI race. And let me tell you, they are locked in an absolute battle for dominance. They are pouring truly mind-boggling amounts of money into developing and controlling artificial intelligence. The scale of these investments, it's honestly kind of hard to wrap your head around.
Just take a look at these projected spending numbers. We're not talking about just big numbers here. We're talking about budgets the size of a small country's. Amazon is leading the charge with a planned $100 billion. I mean, that's more than the annual defense budget of many countries. And it's not just them. Microsoft, Google, Meta, they're all in for tens of billions. Every single dollar of this sends ripples through the entire economy.
And when you add it all up, you get this, an astounding $330 billion. To put that in perspective, that's more than the entire economic output of a country like Finland, all being spent in a single year on AI.
Now, all of this sounds incredibly exciting, right? It feels like we're building the future. But if we decide to look a little closer, peel back a layer or two, you start to see some hidden forces at play, and maybe even a few cracks forming in the foundation of this whole AI boom.
And this brings us to a really critical question. Where is this $330 billion actually going? Because the way this money is moving around isn't as simple as you might think, and it's one of the key reasons some analysts are starting to sound the alarm bells.
Welcome to what some people are calling the AI money machine. It's kind of wild. It works like this. Microsoft invests billions into, say, OpenAI. Then, OpenAI immediately pays that money right back to Microsoft to use its cloud computing services. Microsoft then takes that cash and buys a ton of chips from NVIDIA. And then, and this is the kicker, NVIDIA invests money back into its biggest customers, like OpenAI. Every company along the way records this money as revenue, which, of course, helps push their stock prices higher and higher. This analogy is simple, but it's really powerful. Imagine I pay you $1,000 to dig a hole. Then you turn around and pay me $1,000 to fill that same hole back in. We haven't actually created anything of real value, right? But on paper, we can both claim $1,000 in revenue. Now, obviously, this is a simplification, but it perfectly highlights the concern here, that this circular flow of cash could be artificially inflating the value we're seeing in the AI industry.
But it's not just about the financials. There's another, more technical challenge looming on the horizon. It's something called the data wall, and it could be a fundamental limit to how much smarter AI can actually get using its current methods.
So for years, AI models have been learning by just devouring every single piece of public data they can find. Books, articles, websites, you name it. The problem is, we might be running out. Some projections suggest that by 2027, AI could have consumed pretty much all the human-generated content that exists on the internet. So what does this actually mean? Well, it means the next big leap for AI might not come from just feeding it more of the same data.
it might need a fundamentally different kind of data. Think about it. Humans, we learn from interacting with the real world, from actual experiences. AI can't do that, at least not yet. And getting past this data wall is one of the biggest hurdles for the future of artificial intelligence.
Okay, so we've got a potential bubble, maybe fueled by circular revenue, and a looming data crisis. With all that uncertainty flying around, what is the best way for you to protect your money and maybe even benefit from all this mayhem?
First things first, let's be super clear here. This is not an exact repeat of the dot-com era. The biggest difference is that today's AI companies have real products with real utility. I mean, millions and millions of people use ChatGPT. There's a much clearer path to actually making a profit than many of those old dot-coms ever had.
Still, the signs of a bubble, the overvaluation, the mania, the weird financials, they are definitely there. And nobody, and I mean nobody, can tell you for sure if we're at the beginning of this thing or near the end. That's why having a solid, unemotional strategy is more important than ever.
So let's break down a simple 3-point strategy to get through this. First, and this is always the hardest part emotionally, just keep investing. Stick to your plan. Keep making those regular investments into broad, low-cost index funds. History has shown time and time again that the people who keep buying when things look scary often see the greatest long-term rewards. Second, focus on what you can actually control. Your income. Your income is the fuel for your investments. The more you earn, the more you can take advantage of lower prices if they come. And finally, diversify. This is timeless advice for a reason. Spreading your investments across different things like stocks, bonds, and real estate is your absolute best defense against any single storm.
And that brings us to the final and maybe the most important takeaway here. A potential bubble bursting isn't something you need to fear if you're prepared. For a smart investor, market volatility isn't just a risk, it's an opportunity. So the question isn't really whether the AI bubble is real. The question is whether your financial strategy is tough enough to handle it and maybe even profit from it.